Hello and welcome to my presentation. My question is describe the key monetary and fiscal tools used by the government and the RBA to control the demand of residential and commercial property. Illustrate this with relevant examples and comment on the effectiveness of these tools. Monetary policy, as I'm sure we all know, is the setting of interest rates on overnight loans in the money market, which is a cash rate. This is decided on the first Tuesday of every month, excluding January, and is either changed or not. It has three economic goals: the stability of the currency, which is 2 to 3% inflation, full employment, and the economic prosperity and welfare of the Australian people. Fiscal policy is the changing in the government spending levels and taxation to achieve these same economic goals. So I'll first discuss what the three monetary policy tools actually are, and then how this impacts the demand for the property. So we have the discount rate, the open market operations, and the reserve requirements. The open market operations is arguably the most important and effective tool, and probably the most commonly used. This is a buying and selling of treasury bills or securities from the central bank to other banks. Securities are things such as bonds, loans, and shares. And it can be either contractionary or expansionary. So, for example, if the central bank wanted to expand the economy, it would buy securities from the other banks in order to increase their money supply so they can lower their interest rates and feel pressure to lend out more money. This also decreases the opportunity cost for bank-to-bank loans, so interest rates and federal funds rate will fall with that. So to show how this works, this image shows the central bank either sells or buys bonds or securities from the other banks, which impacts their money supplies, which impacts the interest rate, which is then felt by the individuals and companies. Onto the discount rate. This is the interest rate that a central bank charges other banks if it decides to borrow from them. This is often seen as the last resort and can signify when a bank is in deep trouble. This is often higher than the federal funds rate. So let's say the central bank puts their discount rate at 10%. The other banks then have to have theirs at least 10% in order to make profits. And this is felt by the individuals and companies. Reserve requirements. These are the funds a bank must have at any given time. So, for example, if the reserve requirement is at 10% and a bank has total deposits of $10 million, the bank must have $1 million available at any given time, just in case of emergency withdrawals. Before I get on to discuss how these impact the demand for the properties, it's important to know the property market follows the general economy. So if there's a boom in the economy, there'll be a boom in the property market, and if there's a recession in the economy, there'll be a recession in the property market, as you can see from the red and black lines. So on to how this impacts the demand for the residential and commercial market. So as we know, lower interest rates causes an increase in demand, as it's cheaper to borrow money and invest, whilst high interest rates does the opposite, as it's more expensive and people shy away from borrowing and investing. Confidence also plays a big part. So on to open market operations. If banks, the central bank purchase securities, the banks will have more money supply, as mentioned before, and they'll be able to decrease the federal funds and interest rate. People then see this as a better time to borrow and invest their money, as it's cheaper to do so. Firms may try expand their businesses by investing, so they may demand more commercial property, whereas individuals may see to purchase a property as it's cheaper to borrow. After the 2008 financial crisis, between 2008 and 2013, the US tried this tool, purchased hundreds of billions dollars worth of large assets in order to help the situation and lower the interest rates. It did work to an extent, but because the damage was already so deep, it wasn't too effective. The discount rate, as mentioned before, it's the rate the central bank charges other banks. So an increase in the discount rate will increase the banks to increase their interest rates, which will be passed on to individuals and firms, as it'll be more expensive to borrow money. In August 2007, the US decreased their discount rate by 0.5%, from 6.25% to 5.75%. Prior to this, their monthly discount window borrowing was $0.7 billion. This peaked to $403.5 billion because of their decrease in the discount rate. At the moment, the RBA has set their discount rate at 0.25%, which is the lowest it's ever been, in order to try and help the situation at the moment, due to unemployment being so low, general confidence being low as well. The reserve requirement, so a decrease in the reserve requirement ratio causes for a decrease in interest rates, as banks can lend out more of their money. They do not have to save more of their money up, they can lend out more. Australia itself does not actually have a reserve requirement, along with countries such as the UK and Canada. So when they have a decrease in ratio, it expands the bank's credit and decreases the interest rate. China did this in 2018, decreased their reserve requirement ratio by 0.5%. This released $108 billion into the economy. The reserve requirement is often not used too much, as the open market operations is seen as a much more effective tool. As the reserve requirement ratio it's hard to actually see the impact it had on the economy. Onto fiscal policy. This is the taxation and spending from the government, and it can have two effects: expansionary and contractionary. To expand the economy, the government will decrease its taxation and spending, and to contract the economy, it will increase its tax and decrease its spending. So if, let's say, the example wanted, if the government wanted to expand the economy, it could invest in a project such as the construction of a bridge. This will create jobs, more people without income, and they'll demand more. This is at a very basic level, and confidence will also be higher. Businesses may feel this impact, and they may decide to expand their business, so they'll demand more commercial property. At the moment, what we're seeing is at the end of March, there was $130 billion wage subsidy payment from the government in order to help the situation at the moment. People are seeing $750 per week in welfare payments. And fiscal policy can also be done through doing things such as the Key Start Home Loan, which is basically it was introduced in 1989, and it allows people to deposit 2% of the cost of the house itself. They only have to deposit 2% and it's theirs. It's been around for 30 years and has been very effective. It's done over 100,000 loans. The only negative is the loan you pay back is actually higher than the interest rates than the banks pay, but this is done to, when people can afford to start paying it back, they'll look elsewhere, so it'll be able to free up loans for someone else. And another example of a fiscal policy from the government is the First Home Owners Grant. This is a one-off payment of $10,000 on the first home as buys to build a residential property. In conclusion, the government and the RBA use monetary policy and fiscal policy to impact the demand through open market operation, discount rates, reserve requirements, which changes the interest rates, which plays a massive role in impacting and controlling demand. And through fiscal policy, it can change the spending and taxation. Through welfare payments and through programs such as the Key Start Home Loans and the First Home Organ Owners Grant. Thank you.